Free Book Summary presents
A random walk down Wall Street summary. One-sentence summary. A random walk down Wall Street explores how the individual investor can make money in the stock market by following a simple path that is guaranteed to bring success if the investor has patience and gets accustomed to a series of concepts about stocks and what analyzing them consists of. Investing is often considered to be a difficult job, and financial success as a result of investing in the stock market is a product of highly knowledgeable Wall Street traders. This theory is not only wrong, but it discourages individual investors from building portfolios and long-lasting assets. A random walk down Wall Street, a time-tested strategy for successful investing by Burton Malkiel steps in to help the individual investor take charge of their financial journey and discover valuable opportunities to put their money into and benefit from later on. Usually, a successful strategy consists of investing in a low-cost index fund and keep doing so with every income stream you encounter. Then, you'll see how wealth accumulates in time without being exposed to a high-risk environment, but only if you have the necessary patience to keep investing and trust that the market will do its job in time. You can also try to pick individual stocks, but those will present a higher risk of investment. However, you'll have to learn a few key aspects related to this area of expertise. Let's explore them. Here are my 3 favorite lessons from the book. 1. A healthy dose of risk can be good for your portfolio. 2. You can't beat the market. 3. Learn to control the psychological factor of investing. Seems like a piece of cake, right? Well, as soon as we dive deeper into these lessons, you'll discover some remarkable insights. Lesson 1. Learn to accept risk as a natural part of an investment strategy and your portfolio evolution. Risk is everywhere, and the higher the potential return on your investment is, the higher the added risk. In other words, if you invest in a stock that has a promising future and you expect it to grow significantly, you're essentially exposing yourself to the risk of it performing the opposite. However, if you are indeed right, your stock can have incredible returns for your portfolio. Learn to accept this part of your investment strategy and not fear volatility when it comes your way. Of course, all should be kept within limits. Lower potential downsides are the dream of any investor, so you should aim for blue chips, stable companies with good backgrounds, and a promising future. Protect yourself from losses by using the modern portfolio theory. This theory states that you should invest in companies with inversely correlated returns. That way, you will be protecting your money in every given situation. For example, during the pandemic, you could have invested both in stay-at-home stocks and travel companies. This is so as to assure a winning finale for your assets. However, not all additional risks present the possibility of higher returns. One should be able to correctly assess the value of their investments. One can do this by not buying stocks blindly or based on vague recommendations. Doing your own research is one of the most important parts of investing. Moreover, to fully protect your portfolio, you should diversify it. Don't just buy stakes in companies. Other options include also purchasing bonds, keeping cash, and going for other financial assets. Lesson 2. The market favors those who favor the market back. There are many ways to invest. Some consider themselves active or entrepreneurial investors. They conduct constant research on what stocks to buy, the hottest moves of the day, and how to outperform the market. But wait, what is the market? After all, investors commonly refer to index funds as the market, or the benchmark for their investments. That is because index funds are a broader way to invest, as they incorporate a multitude of companies under the same stock price. Consider the most famous one, S&P 500. This index fund incorporates the 500 biggest companies in the USA, and therefore it represents the market. Investing in it is one of the safest ways to build a stock-based portfolio of assets. Why? Because it performs well over time. However, active investors often want to outperform its returns, as they can prove to be quite low when you check them day by day. Usually, people who love these funds are fine with the idea of investing for their retirement years. Others like to get rich quicker, and so they use fundamental and technical analysis to try to outperform the market. Some even succeed in doing so. However, for the majority of the world, this usually ends up becoming the worst financial mistake of their lives. Stock picking may go well at first, however. Market correction or simply a stock fall could wipe out months or years of carefully earned returns. Therefore, the author advocated for investing slowly and steadily in low-cost index funds and assuring a good Financial future. Lesson 3. Your mind and emotions dictate your moves in the market. While it may be easy for you to say that you've got full control over your brain and your decisions when it comes to investing, time-proven studies on the market may indicate differently. In fact, investors often do the opposite of what they'd like to accomplish in their trades. This is due to faulty traits we have as investors: overconfidence, biased judgments, herd mentality, and loss aversion. Our biased judgment makes us think that we have some special attributes that allow us to call out future stock prices and therefore count as a viable investment. Usually, we tend to be overconfident and biased at the same time and coerce ourselves to buy stocks that don't have a fundamental value but feel like a worthy pick for us. Herd mentality is a strong form of coercion that happens when we feel peer pressure. This derives from our natural inclination to stick with groups of people and therefore change our opinions to coincide with the general group sentiment. In the money market, this can prove to be detrimental to our finances, as we sometimes feel like we should get into hot stocks and not lose the momentum. However, by the time we get on the gravy train, the stocks are overpriced and we end up assisting their decline. Therefore, never buy a stock just because someone else does so, as you're most likely going to end up in a bubble that's about to burst. Lastly, our loss aversion makes it impossible for us to sell a losing position. This is because, as humans, we can't stand to lose. Be rational and always ask yourself if your investment is still viable and worth keeping. A Random Walk Down Wall Street, the time-tested strategy for successful investing, is the book you're looking for if becoming financially independent and having a stable money fund is your goal. This is not a book for those who love get-rich-quick schemes or are looking to retire early. That's because it builds upon the idea that the best ways to invest are low-cost, stable index funds that offer small but gradual returns. Malkiel can't stress enough the idea that you can't beat the market, so it's best to join it. Thank you for listening to the end. You will find even more summary on the channel by subscribing to it.